Nerina, the market taking a bit of a breather after yesterday's strong showing on the JSE. We were up about 2%. Of course, we're still seeing more positive news coming through. We had that China's GDP number out this morning, 11.9% for the first quarter, and that really beating expectations of an 11.5% rise.
Yes, I think our market is certainly bucking the trend on several fronts today, but I don't think it's something to be too concerned about. I think we're seeing quite a bit of profit taking place. We've certainly had a very strong run, not only in our own market, but obviously in world markets as well. And I think traders are really just trying to take a little bit of those profits off the table at the moment, and hence the weakness in our own market, and also the currency may be trading at its weakest levels of the day at the moment.
And of course, we've heard continually from China that there is worry about that economy overheating. It's looking for a growth of around 8% for this year, and yet it continually beats that 11.9% coming through for the first quarter. Do you think the Chinese authorities will have to take action to slow down the growth we're seeing in that economy?
Stephen, I think that is part of where the concern comes from today in our market, that maybe the stronger than expected Chinese growth figures could point to further tightening in the Chinese monetary policy. We feel that there's probably need to be more focus on the currency at this stage rather than on pure sort of monetary policy in the Chinese central bank at this stage. When we received the trade figures from China earlier this week, they reported for the first time since 2004 that they had a trade deficit, and this was on the back of massive oil imports, which we can now obviously see coming through in these very high GDP numbers as well. This has put renewed focus on the whole peg of the Chinese yuan against the US dollar, and a lot of market commentators are looking at this and saying, what will the next move be by the Chinese authorities? Will they allow the yuan to flow freely completely, or will they just allow it to revalue, continue its gradual path of revaluation over the next couple of months? Our view is that they can't really afford to do anything too drastic. Bear in mind that China sits with in the region of about $900 billion of treasury. So any massive revaluation of the Chinese currency will have quite a detrimental effect on the value of those reserves of China. Also, the world economy is certainly still very fragile and cannot afford such an exogenous shock. So although we believe that there will definitely have to be some further adjustments on the Chinese currency, we don't believe that it will be a massive revaluation, but rather a continued gradual readjustment from current levels.
Well, if they did have a gradual readjustment of the yuan, as you're talking about, would that save them from having to tighten monetary policy? Would it have the same effect on the Chinese economy of slowing it down a little bit?
Well, you see, if they allow the Chinese currency to strengthen, that is almost a form of monetary tightening in itself, because what it does is it certainly allows the inflation, domestic inflation, to be lowered, and it will also control rampant growth in their economy. So without them having to put any firm monetary policies in place, they could actually affect some sort of tightening on that economy. And I think that could have quite an interesting impact in terms of commodities, because of course what you will find is then commodity prices will rise in dollar terms, but on top of that also you could actually have an increased demand due to a series of knock-on effects from the changes in the domestic Chinese economy, where a strengthening of the local currency will certainly lead to an increased demands for the likes of luxury goods, cars, traveling, and a lot of these are dependent on precious metals, base metals such as copper and so on. So I think we can find some very interesting volatility coming from our market due to the movements in the currencies and commodity prices over the short to medium term.
Well, if that did indeed happen and we saw commodity prices strengthening in dollar terms, that would then in turn lead to the rand strengthening, wouldn't it?
Yes, actually, and that's why I say we are bucking the trend today, because most of the other commodity-based currencies today are actually enjoying quite a bit of strength on the back of the weakening dollar. But there's also increased risk appetite globally, and if we look at what's happening in the US with earnings season having started off this week, the market started the week relatively poorly on the back of Alcoa's results, which came in slightly weaker than expected. But that was all wiped out yesterday when both Intel and JP Morgan came in with results way ahead of expectations. And not only did that boost the market from a confidence point of view, but it also, the weakening dollar allowed the market to increase its risk appetite again. We're now looking out for results from the likes of Google and General Electric and Intel over the next couple of days. And I think that's going to be another key for us in how the markets unfold over the next couple of days. Currently, market levels are quite rich, but on a forward valuation basis, they are not particularly demanding if the earnings forecasts that are built into these pricing at the moment comes to fruition. If for any reason these big US corporates disappoint on their earnings, I think we could find a significant pullback in the market. However, if they, like the JP Morgan and results of yesterday, come in ahead of expectations, it's just going to provide confirmation to the market that the current levels are not too demanding for where we are at the moment.
Well, some analysts calling this a Goldilocks rally we're seeing in the United States. Would you concur with that?
I think we've got such a massive disconnect between the economy on the ground and the stock market. And typically one would expect in economics that the stock market represents what's happening in the real economy. We continue in this situation where that is not at all the case, and rather where there's a massive fueling of the stock market due to very, very loose monetary policies around the world. So the stock market performance is essentially being driven by excess liquidity, excess cash that is available in the system, relatively low yields and a hunt for yield and therefore higher risk appetite. The extent to which this can actually translate into the real economy is where the key is going to lie. We're still sitting with incredibly high unemployment figures around the world. So consumer spending remains on the deck. We saw that yesterday in South Africa. We see that also in international markets. Although there are signs of improvement, this needs to be followed through with some really robust economic growth figures that we believe can be sustainable. Other than that, we remain cautious, although the momentum of the market at the moment is certainly very positive.
Well, Nerina, not much news coming out locally. We do have a couple of small stories. One coming out yesterday evening, MTN allowing Telkom to piggyback off its network. What are the implications for both of those stocks with this deal?
I think this is a win-win deal for both these companies. Certainly MTN has got excess capacity, especially outside of the major centre and the more regional areas, and this allows them to just actually sell off some of that excess capacity to Telkom, boosting their bottom line because it doesn't add to their cost infrastructure. For Telkom, this just shortens their time to market in terms of their mobile offering, and for them this will be a very, very good transaction. Some market commentators have been critical of MTN going into this deal and saying they are shooting themselves in the foot because they're basically allowing the market to open up to other competitors quicker and easier. We believe that if they didn't do it, certainly Vodacom or Cell C would have been signed up by Telkom any day now as well. So rather MTN than it going to a competitor, because I think MTN have seen the benefits that this has brought to Cell C. If we look back on a roaming agreement that was signed between Telkom and Cell C back in 2001, today this contributes in the region of around 40 million rand per month to Cell C, and this is the sort of number that we believe MTN can certainly also expect to receive from this Telkom agreement.
We also had a trading statement out of Coronation Fund Managers this morning. Of course, that's the only listed fund manager on the JSE. Numbers look like they're going to be up massively on a comparative basis, 150% for the 6 months to March. But of course, the 6 months to March last year was a pretty bleak period, wasn't it?
Absolutely, and I think that's why the numbers appear massive, because it certainly comes off an extremely low base. That being said, it is certainly still a very good number that's come through. They've also reported that their assets under management have improved by 14%, which bodes well for their second half of this year, because that will certainly have a follow-through effect. Their performance has certainly not been bad, but looking at the performance of the market in general, absolute performance funds should have performed exceptionally well, and we didn't quite see that translating through into their fee income. So not all brilliant news, but certainly a great story, and the market likes it, and it's one of the best performers on the day so far.
I see the shares up 2.5%, 10 Rand 25.